Happy Monday. I am logging on today to talk about like a couple of people when they're getting interested into purchasing or selling. It's interesting how much misinformation is out there. So one of the main things that people I guess don't realize is the type of financing will dictate the type of property you can buy in two ways, meaning where it's located and its condition, as well as the price that you can pay. And price meaning two different things. There's one thing about how much, my nose. There's one thing about how much the bank is willing to lend to you based on their risk tolerance and level, as well as how much out-of-pocket cash you are able and willing to contribute to the transaction. So first type of financing, a lot of people, the reason why people will not open doors and show you houses until you are pre-approved is because number one, I've had some buyers who can afford a lot more than the bank can loan them, because they do your debt to income ratio, they also do credit score, and it's also the program. So this particular buyer, there's a difference between pre-qualification versus pre-approval. We don't do pre-qualifications. Pre-qualification is where they're literally letting you do your mortgage app or some information, and they don't really do a thorough background check. The pre-approval is they will verify your documents. They also will essentially, hopefully, do some pre-underwriting, meaning they will run a background on your financial status, verify employment, verify your taxes. That is what we need to know for sure that what your budget is for the house. Not what you set, but what the bank is willing to loan you. Also, what products you qualify for. So, USDA and VA are rural development, and they're also 0% down loans. And a lot of people think that's free money essentially, but in reality, your down payment is only a portion of what it costs to close a transaction. You need to have your closing costs, i.e., as a buyer, you typically don't have to pay for your agent. However, you have to pay for your attorney to do your deed prep, to do your title search. You have to have a title policy to ensure that the deed that they're transferring is having the right ownership, all the ownership rights, and they're transferring to you properly. That requires background checks and all these other, professionals that have to verify that they're conveying a property correctly. There's also, your survey, your appraisal, your inspections. Your lender might charge a funding fee to do the loan, because nothing in this world is free. So all those costs vary. That's why when you ask people, how much do I need to buy this house? We can't tell you an exact figure. The lender might be able to give you an estimate. They call it the good faith estimate, based on, again, your financial status, your credit score, and your, the out-of-pocket. So there are some loans or grant programs where if you get a refund back at closing, that's not allowed. So there are also some products where you can get 2 and 3 mortgages. So like, let's say you get your first mortgage, and then you get a down payment program from the county, and then you get another down payment program from the state. That is considered, you can have multiple liens just to make the transaction work. It's possible. However, there are some, the underwriting will say, well, if the buyer ends up getting a refund, then they can't get funded by a certain amount. Let's say it's a $20,000 grant. If it turns out that when they do their pluses and minuses that you end up getting a refund, they'll say, you know what, you're not getting $20,000, you're getting $15,000. Because there are some people that have learned their lesson from the former mortgage, whole issue back in 2008. So that is number one reason why it's important to know and for you to get pre-approved before you even start shopping. Do not look at these estimators online and, trying to figure out, in your own head. That's what the experts are for. The other thing is, like I said, USDA is 0% down, but USDA is based on geography and income. So there are some people who are over income but are looking in a USDA eligible area, and guess what? They still can't use the USDA product. So the only products that tend to be anywhere is FHA, the government backed loan FHA, which is 3.5% down, and conventional. They also have, so a lot of people don't know that they have, some banks and some lenders have a 3% conventional and a 5% conventional. Conventional is not 20% like a lot of people think. The conventional also depends on your lender. I think my bank's conventional is 10%. There are commercial and investment products where their conventional is 15 to 35% down. So again, that is why you have to know where your money is coming from before we can even talk and look at houses. Before we can even talk about what you set your budget at, we're going to say, did you go to a qualified lender? Because even as a realtor, I can't tell you that I can let you walk into this house because someone pre-qualified you for $300,000, and back when they go back to do your transaction and doing your background check, they realize you've only got $1,500 in the bank, and this loan might qualify for you that you've got to spend about $3,500 out of pocket. And the other thing with that is there are some people who think that you can save it up later while you're in the process, and that's not good enough. If, like, let's say we go through the whole transaction process. Let's say you go under contract, within 2 weeks you get your inspections that you got to pay for, and then another 2 weeks you pay for your appraisal, and let's say we do a quick close. I've been doing quick closes. Let's say we're doing 6 to 8 weeks closing. By the 7th week, by contract, it actually says you have to have your clear to close from your lender, because let's say you close on week 8, at 7 weeks and 3 days, you have to get your, go to underwriting, and they need to know by then, if we close a week from now, do you have all the money? And if you don't, it will also hold up your closing. Then at 7 weeks and 7 weeks and 4 days, you have to get your final disclosure that says, okay, you now need to wire this amount of money to make this deal work. Or you now, and because it takes a couple of days to whatever, you also need to verify that the closing costs are correct, that all the invoices have been approved for. So if your payday is that Friday, then you shouldn't be having your closing that Friday, because if you don't have the money the 4 days before closing, the bank's not going to give you clear to close on Friday. So we talked about USDA having 0% down, VA having 0% down, conventional having 3.3% down and 5% down, and FHA is 3.5% down, and then the commercial products may be 15 to 35% down. But your closing costs was only going to be able to be estimated by the lender or your attorneys in conjunction with the attorney. So you have to get pre-approved so we can know which type of houses to even look at, because like I said, FHA may be 3.5% down, but there are some properties that are not FHA approved. If you're looking in places that have an HOA, or they have like condos, if they don't have a certain occupancy rate, they don't even qualify for sometimes conventional financing. So again, it's very important that we look at your financing before you start to even look at purchasing. We need to know your financial status. And the other reason why it can hurt you is, I had a client, the lender told them from the start, the cost to close on this house was going to be $4,600 total, out of pocket, your inspections, your earnest deposit, everything. And they kept saying, well, if we can save money here or there, if we can not save money, but if we can save on the expenses here and there, then we should be good. But then they ended up getting extra inspections and extra things, and they ended up switching lenders, which actually now had to have different financial fees, and they actually paid for attorney's fees a couple of times. So when they got their final disclosure, they're like $1,000 short, because this whole time they weren't saving their money. And we ended up negotiating on the back end privately just to make this deal work, because at a certain point, we all become liable. The lender puts out money, we put out money as agents, our broker has to be involved with our paperwork on the back end. So it's vital that as a client, whether you're a seller or a buyer, you are completely transparent with your representative, because we can't tell people about your situation, but we can't help you either. So like, if you're looking, so the other thing that happens is buyers have in their mind the type of house that they want before they know their finances. And I always tell people, start with looking in the area. don't start with what you want as a house. So like when I first started buying, I wanted a 4-bedroom, 2.5 bath. I only wanted to spend a certain amount of money, and the problem wasn't that I couldn't get the house I wanted. The problem was most houses did not have an extra half bath. Most houses, only if they had the half bath, it was a 1.5 bath. And it's just the construction in the area that I was looking for. They very rarely had basements because of the topography of the land. They very rarely had lot sizes that could accommodate a traditional 4-bedroom. They're typically 2 and 3 bedrooms because the lot sizes are narrower and the expense to build the house. So there would be like an extra loft, or there would be a sunroom, but it actually had 2 or 3 actual bedrooms and no true master. So over time, I realized that I was willing to get a smaller house, meaning I would rather get a townhome on an end unit or a twin home end unit with a 2-car garage and share one wall, because that house was 1,800, 2,000, 2,100 square feet, because the single family homes were 1,500 square feet, the bedrooms are smaller, and it was a 3-bedroom, 1.5 bath. So when you're looking at houses, understand if you own the land size matters, because that's essentially where your value is in a home. They're not making any more land, but they're taxing, and they're changing their taxing structure based on, lot size, square footage, whatever you want to call it. They don't do it based on your features of your house, interior wise, but they do like, so let's say your land has a deck and your land has a pool. That's why people get assessed at different ratings, because of the way they're utilizing the land. But the land is the important factor. So, but the way some people are offsetting that, especially in the cities, if you've got a condo, your HOA fee might be the same price as your mortgage. So you really want to look at all of these details, especially when you're getting these estimates from your lender. They're putting an estimate of how much they're saying you can afford monthly by line item. They're saying this is your estimated annual taxes, this is your estimated HOA, this is your estimated principal and interest. That matters. So like if we're looking at a house, I'm in Delaware, so we're looking at a house in the city of Wilmington, it's probably going to cost you similar, depending on the price point and the type of house, to get a condo in Trolley Square as it would for you to get a small little townhome or row home in Union Park Gardens, because those ancillary fees add up. But then they also include certain things. When you live in the city, you get municipal utilities. But if you're out in, like, let's say we go to Kent County, living in Camden might cost you similar to what it would be to living in, I don't know, let's say like Harrington. I live out in Harrington. So because you might get more land and you might get less services. So like in Harrington, we have a septic tank and we also have an in-ground oil tanker. So where the house might actually be cheaper, we also have an acre. We get taxed less on our acre because we spend the same price of gas. That's how much we spend per gallon to fill up our gas tank. Whereas when I lived in town in Dover and Camden, sometimes I paid for water, sometimes I didn't, because if you're in the city limits of Dover, your water is trash, sewer, and electric was included. So these little costs, they add up. And that's why you don't want to go to your max whenever you are budgeting for your house, because they will reassess your property values and your mortgage will change. If you are okay with $1,500, but you can go up to $2,000, then you need to start at $1,500 and know in the future that $1,500 might turn to $1,550, it might turn to $1,600, however long you're there. And also understand, like I tell people to estimate about 20-30% added to your mortgage to cover these ancillary costs, because you've also got to do maintenance. You've also got to, you might have accidents, you might have repairs or upgrades that you just want to make. So like after I moved in, I became allergic. I was allergic to everything basically, but I ended up having to get a landscaper because I would break out into hives and have to almost be hospitalized whenever I would be cutting my grass. So you really need to prepare your budget, not on the max at your comfort level, but you should prepare your budget based on what is minimally affordable and prepare for emergencies and prepare for extras. So thank you guys for riding along with me. I hope everyone has a great week. Talk to you later. Bye.